Welcome back to the channel. Still here with my guy John, and we're going to be talking more things real estate. So in the previous video, which I really urge you to go look at, we discussed the different types of investment properties.
Mind you, there are a little bit more, but we were talking about the different strategies that I personally use. And right now that's buy and hold, which is properties that I buy and I rent them out and I hold on to them, right? There's fix and flips, which are properties that I buy that are distressed. I put some money into renovating them and then I sell them back. And then I also do pre-construction as well, which I know you talk a lot about, which is basically when you buy a property before it's even built.
So today we're focusing on the buy and hold aspect. So finding a property, investing in it, holding on to it, and either renting it out to one or multiple people at a time. So first things first, when it comes to, so I've decided I want to get myself a property. I've decided where I want to look. I've decided all of those things. What are the necessary steps that I take after that? Like I decide, okay, you know what? I want to get a house. I want to rent it out to somebody. Where do I start?
Okay, so step number one is the plan.
Okay.
What is your plan? Because ultimately I want to know, maybe if this person has a good savings, maybe we might look into buying a property that we might put some money into it first before we rent it out, right? Because if we go that route, there's another strategy that you can take, which is called the BRRRR method. If you guys aren't familiar, you guys can go look it up. Lots of content online about that. But essentially, to make a long story short, that method allows you to extract all the equity, or most of the equity that you put into the property. You can extract it all or very close to all of it and still keep the property rented out. Maybe you're like, you know what, I'm just trying to get in, I just want to get a rental property, all I got is my down payment. Then I know that particular person needs something that's turnkey, meaning you get the keys, you turn that joint, and it moves. Like it just goes, right? It's already renovated, it's already rented out. All you got to do is take possession and start collecting checks. So that's the first thing. We have to determine where you stand. Now let's just say this person, maybe they don't have any excess funds to do any renovations, and they're just trying to get in. So now that we've determined that, now we got to make sure that this person is properly qualified. So this is your mortgage, the mortgage side of things.
The stressful part.
The stressful part, right? You want to make sure that you can qualify. You want to know how much you can qualify for. You want to know how much you need to put down as a down payment, right? So now once you figured out all that stuff, that's not my job. That's the mortgage broker's job, right? They take care of that. I don't do that. Once you figure that part out, now we know, okay, this person can spend, for example, $500,000 or maybe $300,000, whatever that number is, and you'll also know how much you need to put down, what your down payment is. Because even though the minimum down payment is 5%, that doesn't mean that's your minimum. That just means that is the minimum. So based on your situation, based on how much money you make, based on how much debt you have, will ultimately determine how much you have to put down. So maybe your mortgage broker, your bank says you can go 5%. Maybe they say no, you got to go 20%. But at the end of the day, you will know that in that stage. So at this point, you have all the information that you need to realistically go out there and buy a property. So now that we've established these things, now we can go out there and we know what to look for. So based on this person's buying ability would determine on what areas we look at. If this person can afford something like, you know, very high up, 600, 700,000, you know, maybe we could stay in Peel, maybe look for something that'll be a good property to hold on to. Or maybe that person can only qualify for 200-300,000. So we know we got to go on the outskirts, we got to go to Niagara Falls and see what we can get out there.
There's no shame in you fitting into a certain tier or not. If you are someone that can't qualify for a $600,000-$700,000 tax bracket or budget, there's no shame in that, because you have to start somewhere. And the thing is, the way this economy is built, it's almost like it's working against you sometimes. So you have to play within your means and stay within those means. Because sometimes there might be people like, oh, like, you know what, like I can only qualify for a $300,000, but that $300,000 property can still pay you a really good dividend. That you might actually end up with a situation that's better than if you had a $600,000 or $7,000 property. So I just want to stress that really quickly, because I know a lot of people get deterred or discouraged by hearing those smaller numbers, but you have to still remember, there's a lot to be capitalized on no matter what. The key to this is getting into the industry.
Now, when we're looking for properties, once we've established all these things, we have to make sure this property makes sense. Because remember, this is something that you're gonna hold on to. So this goes back to the 1% rule that we touched on previously. So when I'm looking for a property, because these properties that this particular buyer would be looking for is something that's gonna be turnkey. So all the renovations are already done. So I know if I'm looking for, let's say, $400,000 as my maximum, I want that property to generate about $4,000 a month in gross rent, right? So that's our gross. So that's not our net, meaning that doesn't mean the rent minus the mortgage and property taxes and insurance.
Yeah,
that's your net. We just want to know all the units, whether it's 1 unit, 2 units, 3 units, etc. We just want to know, once we add up all that rent, all that income that we're making, we want that to be about 1% of the purchase price.
It's almost like your revenue at that point. So what you're collecting, you want that to be 1% of exactly what your purchase price was. And the thing is that that's just something that would be a best case scenario, or what you're ideally looking for. That doesn't mean that if you fall underneath that, you're in a bad situation.
So just to give you a great example of that, I have a multi-unit property. There's 3 units in Niagara. That property, I would say the after repair value is about $390. So that property, ideally, I would want it to generate about $3,900 a month. It doesn't. It brings in about $37, right? Is it a bad property? No, because my mortgage on that is only $1,360. So I'm still cash flowing over $2,000 a month. And it doesn't quite meet the 1% rule, but it makes sense.
Because your expenses are extremely low, extremely affordable. So that's a pretty good property there, sir. You know, I might need you to slide me the information on that real quick.
But because it's a rule of thumb, it's just something that's in place to help you figure out whether it's a good deal or not. So going back to that example, if we found this exact same property and, you know, the numbers were 250 and it's generating that kind of income, even though it doesn't hit the 1% rule, I would still say this is a good pickup. And another thing that I recommend people look into is multifamily. Anything below like 4 units or less, the banks consider that just a regular residential property. So you can still put 5% down on 4 units. It's once you get up to 5 units and more, then it's considered commercial, and then you have to go 30-35% down.
Okay.
So you can actually leverage your money very well buying a multi-unit, let's say 4 units. You put 5% down, because now you can get away with over leveraging, because you know that you have 4 units that you're gonna collect rent from. So even though your mortgage payment would be a little higher, doesn't really matter, because you have 4 units that'll probably bring in well over several $1,000s, right? It just depends on where that property is and what the numbers look like. And if you're comfortable, you know, stepping outside your comfort zone and moving a little further out, you live in one of the units, you rent out the rest, and you live free.
That's pretty key, especially for the people who are torn between getting out of the house and kind of having that independence, and also looking into having somewhere where they can kind of invest their money as well. So you kind of get the best of both worlds in a situation if you're okay with living with some people that maybe you're not familiar with.
Well, in a multifamily, they're all completely separate dwellings. So it's like an apartment building, right? So if me and you live in the same apartment building, just because I'm in unit 101 and you're in unit 102, it doesn't mean like we don't share the same bathroom or nothing. We just share the same hallways. That's it. So yeah, people are a little closer to you. Maybe you have someone above you, maybe you have someone next to you, or whatever the case is.
But you still have that privacy.
But you still have the privacy, your own kitchen, your own washroom, obviously your own bedrooms as well.
I want you to kind of also distinguish too, and I want people to understand this too when they're watching this. It's more than just the cash flow at the end of the day. The buy and hold stream when it comes to investment properties is more than just the money you're gonna be making or breaking even on a monthly basis. In addition to the excess amount of money that you're making once you subtract the mortgage from the rent collected, you're actually gonna be making gains on the appreciation in the house, the value of that house over the course of time, because real estate almost never depreciates. Also equity in the house as well.
So we'll start with the debt pay down. So if I have a rental property, and let's just say for the sake of this example, it's cash flowing, meaning after my mortgage is paid, I'm putting $1,000 into my pocket every month. So this property, let's say we hold it over a span of 5 years. That person that's in that property that's paying me rent every single month, they're actually paying my mortgage down. So over the span of 5 years, my equity is going up, because if I have a mortgage for 100,000, but over the years my mortgage is getting paid down and down, that buffer between the two, between what you started at and what it currently is, that's all equity.
Yeah.
Right? And we're not even talking appreciation yet. This is assuming the property hasn't gone up in value at all.
It's even killed the entire time.
Exactly.
Okay.
So over that 5 year, just by paying the mortgage down, you're actually making money on that property. You can pull it out and invest it into something else, or when you go to sell the property, what you're paying back the bank is not the $100,000 mortgage you started with. Maybe now it's only $70,000.
Yeah.
So that difference of $30,000, you didn't pay it.
Yeah.
Your tenant paid it. So not only did you collect $1,000 a month, that's $12,000 a year times 5, did pretty well, right? Then you have your debt pay down. So now as your mortgage is getting paid down, you're making money there as well. So now you have that equity in your property. But then this is where things get interesting. If you buy rights, right? Now you also have equity as well. So for example, Niagara Falls, that's where I focus on, because I know what's going on out there. You have Ryerson University, you have Paradise Walk, which is a resort that they're looking at building. You have Skyscraper, which is going to be one of Canada's tallest skyscrapers that they're building. You have all these things that are happening out in Niagara. So I know that over time, the value is also going to increase, because as other people start coming and developing in the area, putting up more schools and hospitals and things like that, those increase the value of the property. One thing to be mindful of is I never buy a property solely based on appreciation, because to me that's gambling. I might as well go to the casino and go spend some money over there, right? Because you're buying it and you're hoping that it goes up.
Exactly.
So even though all these things are happening, you're still hoping. When I buy a property, I build in my equity. So if I'm buying something, I'm buying it knowing that it's worth this, but I'm buying it at this.
Okay.
So how do I get it here? Maybe I have to renovate the kitchen, or maybe I have to do this or that. But I know I'm building in my equity. I'm not buying it here hoping it goes here. No, I know it's gonna go there because I'm gonna do this, this, and this.
Let's just say that those things, those surrounding factors that you don't have control over do hit, which, I mean, you did your research. So those things are happening, plus the work that you've put in and the renovations that you've put in, plus everything else that we've mentioned already. You're laughing in the next couple of years.
You know, you just have to look for different ways to make money, but that would be the third one. That's the appreciation. So if you find a good property and it checks all three of those boxes, cash flow, debt pay down, and appreciation, that's hands down the best investment, because you're gonna make money in every different angle that you can think of.
Is there ever a situation where you don't suggest that in this 5 year or 7 year span, the appreciation, that you don't capitalize on selling it? Because in order to capitalize on the appreciation, you have to essentially sell the house, correct?
Not sure.
No. See,
So,
I need to ask these questions because I want to get these answers, you know what I mean?
So, okay, let's say I have a property, it's cash flowing great, it's a great property, and maybe I need to extract some money because I want to buy another property. If that property makes sense to keep, because remember, buy and hold is the best strategy there is, period. Because eventually, once that property is paid off, now everything that property is generating is all profits. So if it makes sense to keep it, and you have equity in the home, then what I would first suggest is looking to refinancing the property.
What is a refinancing exactly?
So let's say you have a property and it's gone up in value, right? Or maybe you started paying down the mortgage, or you have tenants that are paying down your mortgage over time, and now you have all this equity in your home, meaning what it's worth versus what you owe against it. So again, let's keep the numbers simple. Let's say what you owe is 100,000, but it's worth 200. So your mortgage is 100 grand, but it's worth 200,000. The banks will actually loan you 80% loan to value, meaning 80% of 200,000 they'll give you a mortgage for. So that's 160. So if you can get a mortgage for 160, but you're in at 100, there's a difference of $60,000 in equity that you could pull out of that property. So once you pull that money out, now you can take that 60 grand and maybe buy another property while keeping the same property, which is where the 1% rule comes in. Because when you refinance, you're refinancing at a higher mortgage. Remember, you're at 100 grand, now you're up to 160.
Yeah.
Which is the 80% of the 200.
Exactly.
Hope you guys are staying with me, right? So now that you're at 160, your mortgage is gonna be slightly higher. So this is where a lot of people can get hurt, if they're not smart with the way they buy. If you're just breaking even and now you have this higher mortgage, now you're at a deficit. Now this property, you don't want to hold on to this because it's eating a hole in your pocket every month.
I don't like losing $1. So if I'm losing $600 or $200 or even $20 every month, it is not making sense.
It doesn't
for me.
make sense.
Especially I need short-term dividends as well as long-term dividends. And if one or the other isn't happening, especially short-term, I'm out. So,
and that's why also having a plan, knowing what you're gonna do going into it. So if my plan going into it, I know that I'm gonna refinance after a certain number of years, I need to make sure I'm buying the right property that will allow me to do that. And if something ends up going wrong, do you have an exit strategy?
With that being said, make sure you go and check out Jay McKay on his Instagram. I'll leave all the information in the description below. Make sure you like, make sure you comment, make sure you subscribe, make sure you stay tuned because we're here talking more things money, more things real estate, more things generational wealth, and we'll be back. Peace.